Hello, everyone. Thank you for joining this episode of Moving Markets, the crypto series. Today, I'm joined by David Sokolovsky, Wealth Advisor with the Learner Group. And today, we're going to cover a couple of topics as we continue to learn together in crypto. So today, we're going to talk about the blockchain and how does it work, kind of high level. We're going to look into crypto wallets and what's behind those and generally how do they operate. And third, where do transactions take place with cryptocurrency? So first, let's start off, David. What is the blockchain? You want to walk us through kind of high level, what is it and how does it work?
Sure. So we have an infographic here that kind of shows how the system works, but at its most basic level, you have a number of computers across the network that essentially records all of the same transactions. So what that creates is a consistent set of transactions and a similar or the same record for everybody, so that there's no questions whether money or another object was sent and transferred. So basically, if you think about it, I would have a computer, you would have a computer, and the folks listening would have a computer that would record any time that I would send, let's say, $1 to you or from you. And if you think about how that's been done historically, is one company would have that. So if you think about a traditional credit card company, they would record all of your transactions and they would be the only ones that have it. Theoretically, those could be changed, but because here you have millions of computers that record all of the same transactions, the record becomes very, very difficult, if not impossible, to manipulate. And so it creates a very consistent and trustworthy record.
And it's fairly instantaneous, David, I would imagine. So if you think about maybe some old ways, like I think about my kids, are they going to know what a check is in the future? So if you look at how we used to transfer money, write out a physical check, I give it to you, you take it to the bank, you hope I have enough money in my account and the check clears, right? And you'd have bounce checks. Is that a thing of the past?
Well, I think that's one of the things that one of the challenges that this solves, because exactly like you said, in the past, you'd receive a check, you take it to your bank and wonder, is the money there? Or we've all heard of the idea of, don't cash this check till Friday or don't cash it till a certain day. So this way, the transactions are verified and you know that the money is coming from an account. So later, it can't be bounced or pulled back. So it takes care of a lot of the ambiguity around whether a payment is going to clear.
Let's talk about another area that seems interesting that, let's think about a pawn store. What do pawn stores typically do, right? You buy and sell goods they're on the market. Do you see security of changing things from a secondary market, and namely pawn stores and stuff that may not have been purchased legally?
Yeah, so the blockchain has a lot of benefits like we talked about. I mean, one is taking care of the ambiguity or the uncertainty of whether a payment's going to clear. There's benefits to the authentication, which I think is what you're talking about. So in the pawn store example, I think we've all watched an episode or two of Pawn Stars here and there. And typically when they bring in some artifact from the past, there's an expert that comes in, takes a look and sees if it's authentic and has to validate that. So one of the benefits with the blockchain that you get is a record of all of these transactions. So if you think about a luxury good, we've talked about this in the past. If you think about an expensive watch or a purse maybe, or even a piece of art. So what it will come with is a digital certificate. Now, if somebody wants to go and transfer that digital certificate when they're selling the product, it's just a much better way to make sure that it's real. So for example, if you bought a Rolex watch directly from the manufacturer, it now comes with a digital certificate. And that digital certificate shows that you purchased it from the manufacturer. When you go to resell it, you have the link to show that you actually bought it and it's authentic. And you can only sell it once. So if you think about like a receipt, somebody could theoretically photocopy it, right? Or a certificate of authenticity, somebody could manipulate it. But in this case, there's just one digital transaction. And if I'm buying it from you, at least I have the benefit of seeing you actually purchased it from an authentic manufacturer or from somebody who bought it from them and transferred it to you down the road. So it takes care of a lot of the ambiguity with security around items that you're purchasing, specifically items that are very expensive.
And each time you're sort of add a chain to the block on the transactions is generally how it works.
Yeah, so the way that it works, I guess at the high level, is everyone records a series of transactions, and those transactions then create a block. So once that block is fixed, we record all of the transactions on all of the different computers. So if you think about it, it's broken down into chunks, and it does take a lot of computing power. So for example, if I was to send you $1, you were to take that dollar and go spend it at the store. A number of those transactions could be listed together, so it just creates one block, and then the next block is built off of those transactions. So for example, you could think of it as either transactions over a period of time or just an overall number. But once that record is set, that block is set, it's recorded on everyone's computer, and all of the next transactions take place from there. So you can't ever really go back and edit a block.
Let's think next about intellectual property. How is this changing intellectual property around maybe an author or those kinds of things?
Yeah, so historically, one of the challenges with intellectual property has been, and we know that with intellectual property law, the person who owns the patent or the rights to something should be compensated each time it's used. I think if we look at different estates, they get compensated like every time a song is played, right? But it's very hard to keep track of that. So one of the things that the blockchain allows, and crypto really allows, is that you can track how a document flows from one place to another. So, and a good example is the college bookstore, right? So if you think about it, you buy a new book, you then maybe go sell it back to the bookstore at the end of the year, or you list it on another marketplace and sell it. Technically, the author should be compensated for that every time there's a sale. Because it's very, very difficult to track. That's typically not done. But with the blockchain, again, you can see how a digital asset like a book in digital format transfers ownership from one owner to the next to the next. And each time there's a transaction, the author should receive a royalty. So this alleviates some of that as well.
Let's turn to the wallets. So when you think, many of us think about a wallet historically, right? We had cash in there, we have credit cards, we had checks maybe. Now as we think about crypto wallets, how is it different or the same, David?
Yeah, so I guess the question I'd ask you is, you listed some of the things in your wallet, right? You listed cash, so currency of some sort, credit cards, again, currency, a debit card, again, kind of linked to currency. But what else? You would probably have an ID in there, typically a driver's license or some kind of identification. You might have pictures, at least historically, right? Before the cell phone, you have maybe pictures of your family. Membership cards, all of these things can be stored in a digital wallet, and we're seeing that with the advent of NFTs, which are non-fungible tokens. So you could essentially carry now in your virtual wallet, not like a wallet that you could fit in your pocket because it would be enormous, but if you think about the things you can carry in there, you can put a lot more different kinds of cards, different kinds of collectibles, things that you'd like to have, authenticity for the items that you're carrying, concert tickets. So if you think about a wallet, it's almost like a safety deposit box or a safe. You can have a lot more in there. But there's two types of wallets, and one is the hardware wallet and one is the software wallet. So I think the traditional wallet is more like the hardware wallet. Some of the cons of a hardware wallet, maybe we'll start there, is if you lose your traditional wallet, if you leave your wallet in the street, there's a good chance that you may never get it back. If you do get it back, you may not get all the cash that was in there back. So with a hardware wallet, you have a secure, typically like a USB drive, that stores all your keys and all of your information, and that it comes with certain benefits and certain drawbacks. The one drawback, the biggest one that I mentioned, is the fact that if you lose it, you really don't have the opportunity to get it back. There's a story you can Google that talks about a man who threw out a wallet with, I think, over $300 million worth of crypto on it at the time. I think that number is a lot higher now, and there's a lot of instances of people losing it, forgetting their passwords, etc. But some of the benefits of it are that it is more secure. So if you think about stories of ransomware or any kind of attacks on servers, etc., the hardware wallets avoid a lot of that. On the flip side, you have the software wallet, which just comes with the convenience. So that's something that lives as a piece of code or a piece of software on your phone. You can access it anytime from anywhere. It's essentially in the cloud. So you can pull it up from your computer, you can pull it up from your friend's house, but then it comes with those kinds of risks that we've seen from time to time where either an exchange can get hacked, somebody can get access to your computer and lock it down, and you have to pay to unlock it. And so there's issues of security and there's pros and cons to both. So I think if you're exploring these different options, it's important to ask what's more important. Is ease of access more important than the security? And how organized am I with my things, and how likely am I to lose this device that may have some or all of my money?
Well, if we look next, if you're lucky enough to have some money in your virtual or crypto wallet, and now you want to buy or sell crypto, let's talk about that. How's this typically work right now?
Yeah, so right now there's a number of different exchanges that are out there, and so it's not very different. I think if you take the parallels from things that we know and are familiar with, I know crypto can sound like it's very complex or overwhelming, but there are direct parallels to it in the same way that we have, for example, with, like I said, a traditional wallet or with a traditional exchange. So the way that a crypto exchange works is you can do it online. So you can download one of the popular ones that are listed on various different websites. But essentially, you have the exchange that you go on. You can pull money. You can link your bank account. So take your traditional currency like the US dollar and transfer it into this crypto wallet that we talked about. Some wallets are linked with exchanges. So for example, Coinbase is one, Binance is another. So on these exchanges, you can have your wallet integrated, and then you can link it directly to your traditional bank account, let's say, for example, Chase, and you can pull money, let's say $100 from your Chase account to your wallet. That's just a transaction that you process once it's linked, and then you can select which cryptocurrencies you want to buy. And as you're buying currencies, so thinking about Bitcoin trading around $60,000, let's say, Ethereum trading at a couple $1,000. So if you wanted to buy $100 worth, you can definitely do that. They're divisible to any US dollar equivalent essentially. And so if you're buying any of these tokens or coins, what you're doing is converting it at today's rates, at the rate at the time that you're doing the transaction, and you can buy a tenth of a coin, a hundredth of a coin, and some of them go out to 6 or 8 decimal places. So you can be very, very specific with it. Unlike a traditional dollar, I guess where you have pennies, you could break it down to 1%. You can get a lot more defined with cryptocurrency.
But how does trading work, David? Is it free? Are there charges?
Yeah, so it really kind of depends on the different networks, and depends on the networks, and it depends on what you're trying to buy. So I'll give 2 examples. If you're using a platform like Coinbase, they have the traditional platform and the professional platform. Both of them are free to anyone who joins. If you use the traditional platform, the fee is a little bit higher. It's about 1.5%. If you use the Coinbase Pro, which is free to anyone, that is about 0.5%. So there is a difference in fees, but I think the fees get very, very high once you start thinking about some of these non-fungible tokens. And that's what some of the future coins and different systems will look to solve. So I'll give an example. I was looking at transaction fees, which are essentially called gas fees. And in some cases, they can be significant. It could be, sometimes more than the price of an item that you're trying to purchase. And it really depends on when transactions are going through. So typically those fees are lower in the afternoon on a weekend when maybe not as many people are sitting in front of a computer, and are typically much higher during a traditional work week where you have folks who are doing this, as their job. I guess one other thing to point out about exchanges is that unlike the stock exchange, which is closed for some holidays, is closed in the evenings, the crypto exchanges are open all day and all night, 24/7. And so what that creates is, obviously a lot more opportunity to do trades, but it also requires you to pay a lot more attention to it, because something can happen in the middle of the night that results in the price moving significantly.
The other thing you have to be aware of as you look at exchanging, if you think about traveling and you fly into another country and you want to exchange some US dollars at the currency exchange, many times you'll walk in and you'll see the currency exchange and it says free, right? But then when you look at what the exchange rate between the currency is of what they're offering and what you're actually getting, the charge is the spread between where the real market is and where you're exchanging. So when you look at some of the crypto exchanges out there, there might not be a transaction charge, but when you look at what you're going to transact at and where the spot market is, that's the spread. So the fees could be significant when you look at areas like that. With that, we want to thank everyone for tuning in today. Today we covered blockchains at a high level, what they are and how they operate. Crypto wallets, how they compare to kind of old wallets and how they're utilized. And then exchanges, how do you buy and sell crypto? And then on the next episode, Angela Grannon's going to join, a wealth advisor with the team. We're going to be covering misconceptions and myths around crypto. So with that, thank you again for tuning in.
Thanks.